Most Americans think investing is still a game played by sharp guys in expensive suits with secret stock tips and insider connections. But here's what nobody tells you. That world is already dead. And what replaced it? Something far more powerful, far less human, and growing faster than almost anyone realizes. Not long ago, Wall Street ran on relationships and gut instincts. If you wanted to grow your money, you hired a guy, a real person, someone who read earnings reports, sat through conference calls, studied balance sheets, and then, at the end of all that research, went with his gut anyway because a stock just felt right. Which, if we're being completely honest, is basically just horoscopes for people who own boats. And for a while, that was fine. Markets moved slowly, information was hard to get, and if your guy had the right connections, he genuinely had an edge. But then something shifted. The data nerds showed up. We're talking about mathematicians, statisticians, people who dreamed in probability, distributions, and treated the stock market like one giant equation waiting to be solved. And in the late 1980s, these minds started asking a totally different question. Not Knack, is this a good company? Yeah, but Rich, given these variables, what does the math say? Thumb rules over rumors, probabilities over predictions, models over hunches, and it worked. Quantitative hedge funds started appearing everywhere, but none of them came close to what one man built. His name was Jim Simons, former codebreaker, math professor, and founder of Renaissance Technologies, specifically the Medallion Fund. The Medallion Fund is widely considered the most successful investment vehicle in human history, and most people have never heard of it. For over 2 decades, it generated returns above 60% annually before fees. After fees, still around 39%. Warren Buffett, the greatest stock picker who ever lived, averaged roughly 19% annually over his entire career. Put $10,000 into Buffett's returns for 20 years and you'd have around $324,000. Put that same $10,000 into the Medallion Fund, and you're looking at over $7 million. Same starting point, very different destination. The Medallion Fund didn't rely on stories or hunches. It fed on data. Price movements, order flow, volatility patterns, thousands of variables, processed at speeds no human brain could compete with. And quietly, it changed everything about how serious money gets managed. But while institutions were moving toward quantitative strategies, something different was happening for everyday investors. Because by the early 2000s, a very uncomfortable truth was impossible to ignore. Active fund managers, the guys you were paying good money to beat the market, were consistently failing to do exactly that. Not occasionally, not in bad years, consistently. Study after study showed roughly 90% of active equity managers underperformed their benchmark over the long run. And after you factored in their fees, even worse. So investors started asking the most logical question in finance. Why am I paying someone extra to get worse results? That question gave birth to the index investing boom. Instead of hunting for the one winning stock in a field of thousands, everyday Americans started buying the entire field. Low cost, passive, no guessing required. And just like that, the traditional stockbroker, the guy who used to be your gateway to the market, started becoming irrelevant. But here's where it gets really interesting. Because even as people moved away from active managers and toward index funds, there was still a real need for portfolio management. The boring but important stuff: rebalancing, asset allocation, tax optimization. Enter the robo-advisor. Platforms like Wealthfront and Betterment didn't show up trying to outtrade Renaissance Technologies. They showed up to replace your financial advisor's Excel spreadsheet. And the growth has been staggering. 10 years ago, Wealthfront managed $2 billion in client assets. Today, $80 billion? That's a 40x increase. Globally, robo-advisors managed $187 billion in 2017. By 2023, that had grown to nearly $2.8 trillion. And projections put that figure at $4.7 trillion by 2027. This isn't a trend. It's a structural transformation. But before you hand your entire savings over to an algorithm, there's something you need to understand. Because most people get this completely wrong. Robo-advisors market themselves as personalized investment solutions built just for you. You fill out a questionnaire. Your age, income, goals, risk tolerance. It feels custom. It feels thoughtful. It feels like the platform truly gets you. It doesn't? After you answer those questions, you're not handed a one-of-a-kind portfolio. You're sorted into a bucket, a model portfolio shared by thousands of other people who answered similarly. The personalization is about as custom as choosing between small, medium, and large at a fast food counter. That's not a knock on robo-advisors. That's just what they actually are. And knowing that changes how you should think about using them. So what are robo-advisors actually replacing? Not genius-level portfolio management. They're replacing the operational layer of wealth management, the stuff that used to require a guy named Gary, a laser pointer, and a 1-hour meeting just to explain why your portfolio needed rebalancing. For decades, financial advisors weren't really being paid for market-beating insights. They were being paid for access. Access to markets, access to products, access to information that regular people couldn't easily get on their own. And then the internet arrived. Market data became free. Research tools went mainstream. And suddenly the information advantage that financial advisors had built entire careers on evaporated. Think about what happened to travel agents. They didn't disappear because Americans stopped taking vacations. They disappeared because booking a flight stopped requiring a phone call. Same principle. Whenever access to something becomes free, the middleman gets replaced by technology. That's exactly what robo-advisors are doing to the investment management world. So here's the real story. It's not about whether robo-advisors are good or bad. It's not about whether quant funds are fair or unfair. It's about what always happens when technology finally reaches an industry that stopped evolving. It doesn't make small adjustments. It rewrites the rules entirely. The question isn't whether this shift is coming. It's already here. The question is, are you paying attention? Drop a comment below. Have you used a robo-advisor? Would you trust one with your money? Let's talk.